So a lot of what we're seeing on the markets and, the future from here on out still dependent on what actually plays out in the Eurozone. The firepower of the European financial stability funds in focus right now. On that end, what's sentiment like in terms of what we're seeing come through with Germany now having voted to enhance the fund?
Well, it was never likely that Germany was going to renege on its commitment to the European Financial Stabilisation Fund, and that's what yesterday's vote suggests. And what is really more of an issue is whether Germany is going to increase its commitment in the future, and that looks very unlikely. Germany has drawn a line in the sand and said, we will stump up what we have offered so far, which is equivalent of $3,000 per head for every German, every member of the German population. But we don't think that they'll do any more than that.
So what do you see, the ramifications being from here on out, Max, because lots of contention and dependence being placed on this fund, but as you say, not the fail-safe?
Well, the point is that what markets are concerned about is not so much the European problem, but the risk that that ends up with a banking crisis which spreads around the world. So investors want to see some reassurance that European banks, both within the safe countries of the Eurozone and the periphery, will be recapitalized and provided with liquidity. Once they have that reassurance, then I don't think they require a solution to the Eurozone, which certainly isn't visible at present. But so long as we see the risk of a banking collapse, another Lehman's if you like, disappearing, then I think equity investors can be reassured and then can start looking to the improving economic prospects in the US and emerging markets in Asia.
Of course, for now, with these issues and developments still unfolding and stealing much of the market attention because of the threat it poses to the global economy, coupled with the US's state of affairs as well, we've got much debate on where the markets are actually headed. I spoke to a convert this morning saying that he's not as bearish as he's been in the year so far, that he's looking to take on a bit of risk now. What's your view on the markets and where we're headed?
Well, equity markets, for example, are discounting both a severe global recession, and perhaps a global recession without end, and a consequent collapse in corporate earnings. Neither looks particularly likely. It looks more likely that actually the US economy will bounce back next year, and that pessimism about corporate earnings is vastly overdone. If that's the case, then the equities will rebound pretty strongly at the point at which they are reassured that there will not be a global banking crisis as a result of the Eurozone.
Having said that, there's an importance in drawing distinction between country balance sheets and corporate balance sheets globally right now, right?
Oh yes, that's certainly true. All the evidence suggests that companies are doing pretty nicely. Their balance sheets are strong, cash flow is strong, profits are strong, and they're rising. Analysts are cutting back on earnings estimates, both for this year and next year, but they still show pretty strong growth. However, what the market is discounting is a collapse in corporate profits, and we think that's pretty unlikely unless there is, as I said, a global banking crisis.
So that's the broad context. What's your approach to the markets at this stage of the game from an asset allocation point of view?
Well, from a long-term point of view, you want to be long the risk assets, but you have to be aware that for the Eurozone to give the explicit guarantee on its banks, which I think investors require, may require further turbulence. So we're ready to add sort of quite significantly to risk exposure into that turbulence, but we're just holding off for right now.
Just looking at where you're seeing value, I mean, you've highlighted the banking industry as being one of them. Broader than that?
Well, we wouldn't buy equities in the banking sector. We just think their long-term models are bust, really. They are not going to generate the sort of returns on equity which investors demand. Among banks, we'd probably prefer the bonds, the investment-grade bonds and even the high-yield bonds. But elsewhere in equity markets, we see sort of value more or less across the board. Even in Europe, where the earnings of a lot of companies are much more dependent on the global economy than they are on the domestic economies of Southern Europe.
That seems to be the trend that persists when you are looking for, exposure to equities and, companies within the developed markets, that you've got to be looking for those with that emerging market footprint and that global footprint more than anything else.
Well, our focus is going to always be on bottom-up stock selection, buying the right companies around the world, rather than on some sort of top-down decision based on geography and sectors. That really doesn't work for us. But we just find that if we go around the world and find the well-run companies, that we get much better performance from that area than from trying to make sort of top-down decisions based on sort of what tend to be arbitrary judgments about countries and regions and sectors and themes.
Max, so let's get a bit specific when it comes to companies that are stealing your attention right now, and it doesn't have to be within the European territory. Globally, what's looking exciting for you?
Well, I think that a lot of stocks are oversold, but again, our sort of thesis in equities is we don't necessarily want to go and chase after the massively oversold, deep value, problematic companies. For example, the European banks. Those can give you pretty attractive returns in the short term, but it's pretty speculative and not the basis of long-term investment. We think that when markets are weak, the best thing to do is to buy the good quality companies with sustainable long-term earnings growth at attractive valuations. You can always buy cheap companies. Cheap companies are always cheap, but quality companies are very rarely good value. And you have to use the opportunity of major market setbacks, like we're seeing at the present, to buy those.
Many seeing the potential in consumer companies, specifically with those, as I said, with exposure to emerging markets. How do those rate in your book? So the likes of a Nestle, a Unilever even.
Well, that has been a very happy hunting ground for our global funds, and we continue to have significant exposure to those areas. That said, in relative terms, a lot of those companies are now looking quite expensive. So, if anything, we're looking elsewhere for investment ideas. But yes, those companies are reassuringly expensive because of their quality and the persistence of their earnings over the long term. So we don't mind them being a bit expensive, but we are finding better value elsewhere at present.
Where exactly?
Well, I think that the cyclicals are potentially an interesting area, and also think areas like healthcare, which is regarded as a value area, but what we believe has got long-term growth. We think the tech sector's had a very strong run last year, has come back perhaps more than it deserves, so we think that's an interesting area. And we think, for example, commodity equities are massively oversold. It's not because commodity prices aren't volatile, yes they are, and there are worries about resource nationalism, but cost pressures are coming down and companies seem to be improving the profitability of their operations, and that's what really counts. It's not about the commodity prices, it's about volumes and margins of the commodity companies, and we're getting quite optimistic about those areas.